for the second part of F1. So I'll get that up here. And I'm going to go ahead and start the recording for tonight. And let's go ahead and pick up where we left off last time in F1, looking at, where's my F1 textbook? Sorry, guys, I got a little glare here. I can't quite see what I'm looking at. As we start to go into comprehensive income. Okay, now I always kind of, guys, forgive me. I'm going to close this blind for now because I think it's giving me too much glare. That's, I think I should be okay now. Yeah, that's much better. As we take a look here, I always kind of laugh when we start talking about comprehensive income, because I feel like you're a CPA, you're an accountant when you have to start saying things like what are described here, which is your comprehensive income. Okay, comprehensive income is equal to net income plus other comprehensive income equals comprehensive income. So you're not talking like most people when you have to remember things like that. So comprehensive income is our net income, which we've learned at the beginning of this chapter. Net income is my revenue minus my expenses, gives you my operating income. Then I have what? Non-operating items, right? That gives me my operating, my income from continuing operations, excuse me. And then I have what? I have discontinued operations in the calculation of net income. And now we're going to keep going with that and say, well, when you have comprehensive income, you have to add other comprehensive income to your comprehensive income. You wanted to be an accountant, okay? So this is the kind of stuff you got to start to learn the terminology on. Now, they give us the definition here, which is comprehensive income is the change in our net assets and our equity of a business enterprise during a period from transactions other than events and circumstances, okay, from non-owner sources. It includes all changes in equity during a period except those resulting from investment by owners and distributions to owners. Now, when you think about that, investments to owner and distribution to owner, they're talking about what? Purchases of stock, and they're talking about payments of dividend. Okay, so comprehensive income are all changes in my equity except for, and this is the flashcard, it's changes in my equity, okay, except for, well, let's put the exception, stock issuances and what? Dividends. So just flashcard that, okay? So when you look at a question, they say, which of the following would constitute comprehensive income? It's anything that would change the stockholder's equity, net income, the other comprehensive income items that we'll talk about here in a second, anything that would change stockholders' equity except what? Except stock issuances and the issuance of dividends, okay? Now, you come down and they show us that we have our net income, so we know already, but let's just review that. Net income includes our income from continuing operations. That's what? That's my operating items, my non-operating items, gives me my continuing operations. And then if we have a discontinued operation, we would tease that out separately on our income statement. And then to get comprehensive income, we will have to do what? We'll have to add other comprehensive income. And my other comprehensive income items are made up of, or constituted of, pension adjustments, which is the P in this mnemonic puffer they're going to give you, unrealized holding gains and losses on available for sale security, foreign currency items, instrument-specific credit risk, and effective cash flow. So I think they call that puffy, okay? That's the mnemonic, and you can go ahead and flashcard the elements that constitute the other comprehensive income. But remember, my comprehensive income is everything that changes stockholders' equity except what? It's stock issuances and dividends. Okay, that's the easiest way to remember it, but you can also flashcard the elements of my other comprehensive income. Okay, now when you take a look, there are two ways to report this other comprehensive income. So what I want to do is I want to go over to page 61 and 62. We'll come back to some of this other stuff here in a second, but just look at ways of reporting my comprehensive income and my other comprehensive income. One is the single statement approach, okay? And what you do is, you don't need all this detail. They're making this into like a problem that is throwing the baby out with the bathwater. I just want you to show you the presentation here, which is the statement of comprehensive income. We have our income statement, essentially, revenue, expenses, right? Income before income taxes. There's our tax. There's our net income. Apparently, this company didn't have discontinued operations. And we have what? We have our net income. And then with the one statement approach, what you do is you just keep going. You keep going now, and you start adding in other comprehensive income items, unrealized holding gains on available for sale securities, foreign currency items. That gives me a total for my other comprehensive income. Net income plus other comprehensive income gives me comprehensive income. Now, when FASB proposed this, companies were like, I really don't want to mess up my income statement by having to keep adding stuff to it. Would it be okay if we had a two-statement approach where we just kept the income statement the way it is and then broke out a separate piece of paper and made a statement of comprehensive income? So that's what they did. They take the net income, they just bring it down from the income statement, right? They bring it over from the income statement. And I think most companies, by the way, I haven't seen any empirical evidence on this, but I think most companies take the two-statement approach, okay? And then they just start bringing down these other comprehensive income items. And that gives me my other comprehensive income. Net income plus other comprehensive income gives me comprehensive income. Okay, so you have that option of two statements, one statement or two statements. Okay, question. Okay, good. Now you come over and they start talking about this idea of, and I want to come back. They start talking about this idea of accumulated other comprehensive income. Okay, and what I want you to do is right next to this a little reminder that this is like RE, retained earnings, for my other comprehensive income. Remember, we're reporting other comprehensive income on the income statement. So we report that by year. With net income, we do what? We close that out to retained earnings, right? With other comprehensive income, that gets closed out to accumulated other comprehensive income. So let's just read this. Accumulated other comprehensive income is a component of equity that includes the total of other comprehensive income for the current period and all previous periods. Now, when they say it includes, of course, just like retained earnings, it adds up over the life of the company. Other comprehensive income for the current period is closed to the account, which is reconciled each period similar to the manner in which retained earnings are reconciled. I don't know what that means, reconcile, but let's just look at the example here, and I think you'll get a feeling for the other comprehensive.
May I ask a question?
Yeah.
Oh, you're writing, I'm sorry. It's a like RE for OSI. What is OSI? OCI mean?
Other comprehensive income.
Okay, thank you.
Yeah, okay. OCI is other comprehensive income. OCI. Okay, other comprehensive income. Okay, good. Now you come over and I want to look at this example, okay, with you. And remember, we said that one of the items that constitutes the other comprehensive income is unrealized holding gains on available for sale securities. Now we're going to get into accounting for marketable securities in F4, but let's just spend a couple seconds to review how you account for available for sale securities. So FASB has three categories that you can put your trading securities in, right? And if we're talking about stocks, we can have them in bonds, we can have them in trading, and we can have them in available for sale. And then we also have held to maturity, but only bonds will go into obviously held to maturity because stocks don't have maturities, right? But let's just go ahead and talk about the three categories. Okay, so if we have a trading security, that means we're trading that security on a daily basis. And since we're trading that nearly on a daily basis, then we will mark that security to market every period at the end of the year. And we will do what? We will take any unrealized holding gains and losses, and we report it directly on the income statement as part of my net income, right? If we are talking about an available for sale security, with an available for sale security, we treat the balance sheet the same. We mark it to market on the balance sheet, but unrealized holding gains and losses don't go straight to net income. They go to, and they really are affecting equity directly, but users of financial statements were complaining about things like that. They were dumping straight into stockholders' equity. They asked FASB, can you show us a presentation as to how it would look if it were to affect net income? And that's when FASB came up with this idea of comprehensive income and other comprehensive income. They say, okay, we'll go ahead and show you how it affected net income. And you saw how something like that is reported either using the one statement or two statement approach. Okay, so in this example, what I'm doing is I'm assuming that I have an available for sale security that I purchased in year one. Okay, company purchased it in year one, and they purchased it for $500,000. Now, of course, when you buy the security, you debit the security, $500,000. Of course, you got to pay for it, so you credit the cash. Now, at the end of year one, they still have the security, but when they look, the market value of the security had gone up to $600,000. So we have what? We have a $100,000 unrealized gain. So we go ahead and debit the security. So now for the 100,000, so now it's showing what? 600,000 on the balance sheet. It's being reported at market value, which is what you're supposed to do for an available for sale security. And we will credit unrealized gain, okay, for 100,000. Now that unrealized gain is an other comprehensive income gain. Okay, so when I look at my year one statement of comprehensive income, and I just made up, guys, this 50,000 is the net income. I then, as I report my OCI items, my other comprehensive income items, I will put the 100,000. That's what? That's that item right there. Okay, I went ahead and I credited my other comprehensive income, right? So I'm just picking up the balance in my ledger account for that. And so I have 100,000 that's reported there. And my comprehensive income, guys, and I think I have a little typo here. It's 100 and what? 150,000 net income plus other comprehensive income equals comprehensive income. Okay, now we close all income statement accounts, don't we? We have to close income statement accounts. We close our revenue, we close our expenses. And so what I'm showing you here is that we go ahead and we now do the closing entry to close my OCI for the year. So what do? I go ahead and because I had the OCI for year one, to close it now, I go ahead and I do what? I debit it and I credit my accumulated other comprehensive income because that's like the retained earnings for my other comprehensive income. Question?
Yes, I have a question. Where do you get, I'm sorry, I couldn't see where's the 50,000 other comprehensive income come from?
I don't have 50,000 other comprehensive income. I have 50,000 net income, which I made up.
Okay, got it. Thank you.
Yeah. And then I have the 100,000 OCI, which came from the available for sale security. Net income plus other comprehensive income equals comprehensive income, which is the 150. Question? Okay, good. Now, when you go back to the textbook here, okay, let's look at that second note over there. Okay, and this next note talks about reclassification adjustment. Okay, and they tell us reclassification adjustments move other comprehensive income items from accumulated other comprehensive income to the income statement, and they call that a reclassification adjustment. Now, let's just go ahead and take a look at the same example now, continue on with the second year, and it'll make a little bit more sense of what we're talking about there. So when you look at this example, okay, we have a company purchased a second available for sale, same company. They purchased a second available for sale security now in year 2, and I'm telling you that they purchased that one for $1 million. So what happens? Of course, we debit the marketable security 2 for $1 million. We credit the cash for $1 million. Have to buy that, right? And then at the end of year 2, they sell that first marketable security, the one they bought in year 1 for $600,000, and the second available for sale security now I'm saying is worth $1.4 million. Okay. Now, when we sell the security, we're going to do what? We're going to debit cash for the $600,000, credit available for sale marketable security 1 for $600,000. The security is gone, right? We sold it. It's off of the balance sheet now. But then we have to do the reclassification adjustment for that security that we sold. So when we do, we go ahead and we debit our unrealized OCI. Okay, we debit that for 100,000. Okay, and then we credit realized gain for 100,000. Now that realized gain is going to show where? It's going to show, because it's realized, I'm just going to show you right now, it will show up on my income statement, right? And I'm just putting it directly to net income. You know, I'd have gain, realized gain from sale of marketable security, but it's going to cause my net income to go up 100,000, right? Because I sold that thing and it's on the income statement now, right? Okay, that's the reclassification adjustment. And then I have to account for what? I have to account for this second security that is gone up 400,000 in value. So I debit the available for sale security 2 for 400,000. Now it's showing 1.4. I credit my OCI, realized gain, for 400,000. And so right now I'm showing what? Net, I am showing the OCI for year 2 to be 300,000. It is what? It is constituted of the reclassification adjustment in which some came out of the accumulated other comprehensive income and what? And some came in. So now when I close my comprehensive income, okay, what'll happen? I'm going to go ahead and I debit it 300,000 and I credit what? I should probably put a 3 there so you realize that's the same entry. And I go ahead and I do what? I credit my accumulated other comprehensive income, and the accumulated other comprehensive income is showing what? 400,000, as it should, because I have a security that's now worth what? 1.4 available for sale, and there's 400,000 in my accumulated other comprehensive income. Question? Okay. Now, the unrealized holding gain that's reported there on my statement of comprehensive income is the net of the increase for the held security and the decrease caused by the reclassification adjustment for the security, for the sold security. As a result, the company would disclose information shown at the bottom of page F164. So let's just look at that. I don't know if it's quite at the bottom, but let's just go ahead and take a look at what they tell us on page F164. as to things that need to be disclosed for reclassification adjustment. So when we look at that, come back to full screen here. And I already showed you the two approaches, the single statement approach versus the two statement approach. Okay, so we've already seen that. Okay, and then we're going to come down, we're looking at the required disclosures, and let's just go straight. We'll come back to a few of those others here in a minute because I'm going to have you flashcard all these required disclosures. But the reclassification adjustment, come on, you damn thing. 1 second, guys. Okay, the reclassification adjustment were made to avoid double counting and other comprehensive income. That's just FASB's way. And I don't know, I wish FASB would stop talking like that. They're such nerds, okay? But to avoid double counting and other comprehensive income items that are displayed in net income for the current year. And it's like, what the hell does that mean, right? And then Becker does a good job translating it into English for us, which is, e.g., previously reported unrealized gains on available for sale securities that were realized during the year. In other words, you have to class it out, right? You have to class it out of other comprehensive income by debiting the other comprehensive income and doing what? Crediting the net income or the gain on the realized gain that's reported on the income statement, okay? Now, they show us disclosures that are required for this and change for reclassification adjustments and changes in accumulated other comprehensive income, balances by component of other comprehensive income. The entity must separately disclose reclassification adjustments and current period OCI. And when you look at, I'm going to have you put there, see page 64, example 1. And then we have significant items reclassed out of accumulated other comprehensive income must be disclosed either on the face of the statement where net income is presented or a separate disclosure in the notes of the financial statement. And they give us an example of that on page 64, but that one is going to be example 2. So see page 64, example 2. Okay, so let's just go over there and let's look at page 64 and let's look at the examples. But what I'm going to do is I'm going to put a column over here for our available for sale security example. Okay, they start bringing in foreign currency items and we haven't talked about cash flow hedges or anything, so it almost becomes impossible to understand this example. That's why I gave you the more simple example here so you can kind of see how these disclosures work. So we would have had what it would have been for our little example would have been for the year 2. This would be the year 2. And the beginning, changes in the accumulated other comprehensive income by component. Beginning balance was what? For our purposes, for the little example we had, the beginning balance was 100,000, wasn't it? That was for that available for sale security 1 that went from 500,000 to 600,000. So we would have started the year with 100,000. We would have had other comprehensive income before reclassifications would have been what? Would have been 400,000, right? The OCI that we would have reported on our statement of comprehensive income, right, would have been 400,000, but we had that amount that was classed out for the security that we sold, right? So that's the 100,000 that came out, so that the amount net current period other comprehensive income therefore was what? Was 300,000, wasn't it? Okay, so when you look at this part right here, notice that disclosure now explains to the users what happened. We had what? We had 400,000, but then we reclassed some out, and so we netted out to 300,000, didn't we? And you can see that right here because of this disclosure. And then the ending balance, as we saw, was what? Was 400,000. Okay, so that disclosure is necessary so that folks can understand what happened. Users of the financial statements can understand what happened with the reclassification adjustment. Now, that was the example of the disclosure, the first disclosure requirement that I highlighted there. Now we come over and they have this details about accumulated other comprehensive income components, and notice that we would have on here amount reclassed from accumulated other comprehensive income. Okay, and I'm just going to sort of squeeze it in. We would have shown what? We would have shown 100,000 for the available sale of available for sale security. AFS security. Okay, and I'm just kind of co-opting the example here. So we would have shown what? We would have shown 100,000 coming out, and then the line item affected on the income statement would have been what? Gain on sale of available for sale security. Okay, so we would have to disclose that so that you could see, okay, we had a sale, there was an amount that came out of other accumulated other comprehensive income for that sale, because we had to report it where? We had to report on the income statement as a gain on the sale of available for sale securities. Okay, so that's what those two things are telling us: changes in AOC balances by component, and must separately disclose reclassification adjustments. You saw that, and then significant items classified out of accumulation must be disclosed, and we showed that on that second statement. Question. Okay, flashcard these disclosures for the reclassification adjustments. So you remember that those are the required, and you can even put on your flashcard where the examples are, in case, you know, later on you're going to read that flashcard and go, what the hell was this again? So what I suggest you do is you also index it back to the page where you can look at the examples. Say, oh yeah, okay, I remember that. And then make another flashcard, okay, where you will go ahead and you will put some additional disclosures. So we must disclose the tax effect of each component included in other comprehensive income, the changes in the accumulated balances of each component of other comprehensive income. And, you know, that sounds like something special, but then you look, and that's basically what we did right here on this statement of comprehensive income. Guys, those are the changes by component, aren't they? This is what it changed this year. Okay, when I showed you that little example and I showed you that 100,000 showing as a line item on the statement of comprehensive income, that was showing you the change for the period, right? It was 100,000, then it was 300,000, although we had that little hidden reclassification adjustment thing that they made me disclose other stuff for. But that was the change for the period. 300,000 as it went from 100,000 to 300,000, and you have to speak to it by component, whether it's pension, unrealized holding gain, etc. And then the changes they tell us could be shown on the face or in the notes. We gave you the example up there where we showed it on the face, but you could just say this is the total OCI for the period, and then tell them whether it was pension, whether it was unrealized holding in the footnotes. And then the total accumulated other comprehensive income has to show on the balance sheet as an item of equity. And I'm sure you've seen that if you looked at a company's financial reports. You've seen down in the stockholders' equity section, you have retained earnings, you have what? Accumulated OCI is down there as well. Okay, question. Okay, good, guys. Not exactly something that, you wake up in the morning thinking about. And I find that even my CPA students have a little bit of a challenge tying the income statement to the stockholders' equity. Okay, so you got to remember, we close things from the income statement. Everything gets closed, and its resting place is what? Retained earnings, isn't it? Okay, for our regular income items. Accumulated other comprehensive income is doing the same thing. Okay, and then all we do is, if we have that reclassification adjustment thing, they start what? As we take it out of accumulated OCI, and what we're really trying to do is get it out of accumulated OCI and get it into what? Get it into retained earnings, right? Because then we'll eventually close our net income to retained earnings. That's why FASB says to avoid double counting. Okay, talk English, please. They're just trying to get it out of accumulate other comprehensive income and into retained earnings, and that's what the reclass adjustment is. And so we have to put these disclosures that I asked you to flashcard. These right here. Okay. Okay, good. Let's look at a question. Let's look at our first class question today. Okay, I'm going to end the poll. And 69% of us got this right. Okay, and I'm gonna ask folks to kind of tell us why they think some of these are correct. So it says one of the elements of financial statements is comprehensive income. Comprehensive income excludes changes in stockholders' equity from which of the following? So who wants to tell me what comprehensive income is? What is comprehensive income?
Everything except purchases of stock and issuance of dividends.
All changes in equity resulting from anything, any changes other than from owner sources, right? Which is distributions to owners and purchases by owners. Good. So, and we boil that down to not stock issuance, not dividends, right? Okay, good. So is a loss from discontinued operation a distribution to the owner? No, loss from a discontinued operation is what? It's not an investment by the owner. It's what eventually going to affect my net income, and my comprehensive income is net income plus my other comprehensive income, right? Okay, good. Prior period error correction. Okay, what happens? If I made a mistake in a prior period, what am I going to do? I have to fix it, don't I? Okay, and that's going to do what? That's either going to be a restatement of the year affected by the error income statement, or I'm going to have to do what? Or I'm going to have to make an adjustment to the beginning balance of retained earnings for the earliest period presented. So it's going to affect stockholders' equity, and it's a net income item from another year, isn't it? Okay, or it could even be another comprehensive income item from another year. Dividends paid to stockholders, yeah, that's a distribution to owners. That's what? That's other. That's not other comprehensive income, right? That's what we said is excluded. And then I kind of get my feelings hurt a little bit when people pick D, because we just went through a whole example of how unrealized holding gains and losses unavailable for sale securities would affect what? Would affect the other comprehensive income. We just talked about that. Just spent like 20 minutes, a half hour talking about that. 40 minutes talking about that. Question. Okay, guys, if you are just tuning in so that I don't send you a note to say, why aren't you in class? You're wasting your time, okay? You're not getting anything out of this. Life is too short to sit here and have to, you know, kind of play the game to not pass the exam, because I'm reviewing with you things that you have been exposed to already. And we're reviewing these things so that you can prepare for your exam. And if you're preparing for your exam, you know, I always tell new Becker and new instructors, when I used to bring in instructors for Becker, I would tell them, they used to make them observe a class. And in fact, Becker used to tell me, when you have people observing your class, can you teach the class a little worse so that they don't feel overwhelmed as to what it is they're going to have to be doing? And I was like, no, I cannot. I'm going to teach it the way I teach it. But anyway, they would observe it, and I would tell them, hey, don't worry about concentrating on what I'm saying, because it's very difficult to concentrate on what I'm saying if you don't have an exam on the horizon that you're trying to pass, okay? But if you're sitting here and you're getting ready for your exam, you should be hanging on everything we're saying, and you should be understanding the things so that you can then go ahead and answer a pretty basic question like this, so you can build from there and be in position to pass the exam when the time comes, okay? If that's not the approach you're taking, there's still time to kind of reverse your decision to get into this class, because I don't see exactly what you're getting out of it otherwise. Okay. Okay, good. Question on this one? Okay, good. Now you come over and we start talking about adjusting journal entries. Okay. Now the exam will probably give you a good 10 points on adjusting journal entries. Okay. They are going to expect you to be able to read a problem, understand what was done incorrectly, and then select in a multiple choice question, or maybe even a task-based simulation, post the journal entry that will correct the mistake. Okay, so when you look at these, okay, and I'm going to look at a couple of them with you. I'm not going to go through every single example of the potential adjusting journal entries, because it really becomes a question of not memorizing a set of common adjusting journal entries. It becomes a matter of reading comprehension, understanding what was the mistake, and understanding as a professional accountant what should have been, what will correct the mistake, so that we're showing what should be shown on the financial statements. Okay, so just memorizing journal entries aren't going to help you so much here. I'm going to show you a couple, but you should be always thinking, what was the mistake? What should have been done? And how do I correct that mistake so that what was done is corrected to show what should have been shown? Okay, so let's just go ahead and let's just take a look. And they give us a bunch of journal entries here that I don't think we need to review here because those are sort of common sense, or not common sense, but a little too elementary. Let's just look at error corrections. Okay, we don't need rules. We need to read the problem and then figure out what needs to be done. Okay, so let's just go straight to this example. Okay, and they tell us here that the company purchased a $300 3-year insurance policy on January 1st, year one, and expensed it all on the payment date. Okay, so what did they do? They took as insurance expense $300, didn't they? They expensed it all, but it was what? A 3-year insurance policy. So should they have expensed it all?
No, prepaid.
They should not have expensed it all. Good. They need to set up a prepaid, right? So what we want is we want the insurance expense for the period, the balance to show what? 100, don't we? Because 100 did expire, right? Okay, so what do? How do you turn an expense account with a balance of 300 into a balance of 100? You credit it for what? 200, don't you? Isn't that what you do? Okay, and you need to what? We have nothing showing in the prepaid. We want there to be what? We want a balance of how much in there?
200.
We want 200. How do you turn an asset account like prepaid insurance into from 0 to 200 balance? You debit it, don't you?
Yep.
Is it correct now?
Correct.
Okay, and so that's what they did here, even though they didn't show it to you here very well. Okay, but let's just look at the journal entry down here where they give us the solution. That's what they did, right? They debit the prepaid, they credit the insurance expense. Okay, that's the way to think through these questions, guys. And I know they gave us rules, and it's not rules, it's reading comprehension, saying, what did they do? What's, you'll probably have this experience as a CPA. Your job is just not to call people stupid when they do that, right? You need to smile and say, oh, well, I can fix that. And meanwhile, you're thinking, what are you guys doing here, right? Okay, so you just propose the adjusted journal entry in a nice professional way, and you fix the problem. You are the doctor of sick financial statements, right? And you're going to cure them with journal entries. So just take a look at this one. $2,000 of credit sales made during year 2 were not recorded in the ledger balance because they had not been collected in cash. Well, it doesn't have to be collected in cash. We learned that in our very first accounting class, right? So what happens? Well, that means we should have an accounts receivable that wasn't showing anything. There needs to be a balance of what? Of 2,000 in there?
Yeah.
So we have to debit it for 2,000?
Yes.
And then since we must have provided the service, if we're setting up the receivable, then we must have had what?
Revenue.
Revenue of 2,000?
Mhm.
So I credit the revenue?
Yes.
Okay. And when you look down at the solution, I don't like the way they showed this part over here, the way they showed these amounts, and I don't know where the hell they're going. Anyway, don't worry about it. Just look at the solution down there. They debit the account receivable, they credit the revenue. Okay. I'm not going to go through every single one of them, guys, because I think your time is better spent. Our time is better spent moving forward, and you walking through, though, each of these on your own in understanding, practicing that notion of what was wrong, how do I fix it? Okay. Okay, good. And let's practice that with a CPA exam question. Okay, so let's take a look at this question. And I'm going to give you some time to look at this one, but practice that approach of what did they do wrong? How do I fix it? Okay, and you can even use the T account approach like I was showing you. I'm not a huge believer in using T accounts on the CPA exam, but for these kind of questions, I think it's helpful. I don't like T accounts so much because a lot of times the question's asking you what is the correct balance that should be in an account, and T accounts aren't good for that. T accounts are better for just kind of visualizing these kind of questions where you're having to make an adjustment. Okay, but let's go ahead and practice with this. Okay, we're coming up on 3 minutes, guys. So start to wrap this one up. That's the 3-minute mark. Give you 5 more seconds. Okay, now a question like this, you know, I don't think it should take you 3 minutes really on the exam to get this one right. Miss maybe a 2-minute question. Okay, you should start getting to the point where you're answering one like this in 2 minutes. And most of you got it right 77% in a relatively reasonable amount of time. This is a harder question though. This is not the easiest in the world, but you'll get better at these, and you'll start to see over time that you're going to get better and better and have a systematic approach to these. Okay, because you need to have a system. Otherwise, you're going to get all tied up in a question like this. Okay, now what happens? The way you look at this is you say, what did they do? What should it have been? How do I fix it? Okay, that's what you're looking for on a question like this. Now, you look and they say on October 31st, a company with a calendar year end paid $90,000 for services that will be performed evenly over a 6-month period from November 1st, year 1 through April 30th, year 2. Okay, 6-month period. Okay, and they sit there and they say the company expensed the $90,000 cash payment in October year 1. Now to its expense account, okay, to its expense general ledger account. And I always feel like, you know, you're talking to a dog that makes a mess. What did you do? Okay, what did you do here? Okay, what happens? They went and on 1031, they did what? They debit expense for $90,000 and credited cash. Bad CPA. No, that's not how you're supposed to do it, right? So they have an issue here in that they have what? They have expense. And the expense, they debited it for $90,000. So it's showing a balance of $90,000. Meanwhile, they tell me that $90,000 represents what? Represents a payment for 6 months worth of service, doesn't it? Okay, so if I take that $90,000 and I divide that by what? By the 6 months, that's $15,000 per month. Okay, divided by the 6 months, that's $15,000 per month. And if they bought the thing, they paid for the thing October 31st, guys, count on your fingers for questions like this. You make a mistake, you see October, and you think, oh, October, November, December, that's the 10th month. So we must have, you know, 2 months here, 3 months, just count. If they bought it on October 31st, that means it went all of November, it went all of December, didn't it? All of November, all of December. Always make sure you're checking off on your hand what the months are. When I was studying for the CPA exam, I used to count on my fingers. My dad was watching me study because what are you gonna be? An accountant who counts on your fingers, a CPA that counts on your fingers? And I was like, yes, I am, Dad. Get out of here. You're not an accountant. What do you know about it? Okay. So what happens? 15,000. Okay. And it's what? 15,000 October, November, December, about October 31st. That's 2 months. 15,000 times 2 months is what? The expense should have been 30,000. Well, how do I turn an account that's showing 90,000, an expense account that's showing a 90,000 debit balance into a $30,000 balance? I have to do what? I have to credit it for 60,000, don't I? And now it shows the correct amount, the 30,000. Now at that point, I think you're done. Once you get to that point, there's only one choice that gives you credit to expense for 60,000, right? I mean, you're done right there. But thinking through the whole process, now I have what? I have a prepaid. The prepaid isn't showing anything, but I want it to end up showing a balance of what? Of the 60,000 that's left. Okay, so I have to do what? I have to debit it 60,000. Okay, so if you think through these questions this way, guys, and get into that habit of thinking through these, you will have a huge advantage, a huge asset, no pun intended, going into the exam, because you will have 10 points of questions they want to see that if financial statements have a problem, can you fix them? Because you're going to be getting a license that's going to allow you to say that the financial statements are free of material misstatements. So I guess if you find a material misstatement, you ought to be able to fix it. So they do expect you to be able to handle that. Okay. Okay, guys, let's go ahead. I know it's from a clock standpoint a little earlier for the break, but I want to take it now because we're going to go into chapter 2. If we get a little tired, we can take another break a little bit, later. But let's go ahead and take a full 10-minute break right now, and then we'll jump into chapter 2. And in part, I'm doing that because I want to give you the chance to go ahead and print out those couple of documents for chapter 2, the flashcard for changing cash to accrual, accrual to cash. You may want to have that available so you can mark it up when we go through that. Okay. And you should be getting the F2 PDF if you don't have the hard copy of that. Okay, guys, I'll see you in 10 minutes, okay? Let's make it 6:15. Oh, 6:10. 6:15. Now that I said it, it's out there. Gonna have a little bit of a long break here. That's all right. Okay, guys, we're going to go ahead and jump back in now with F2. F2 is kind of a catch-all chapter, even though it talks about financial reporting and disclosure. I mean, that's a pretty broad discussion. I think that there are some more lightly tested areas that at this point make sense for us to get into and talk about these as we have completed our discussion F1 pretty much about the income statement. We get some of these sort of peripheral items out of the way. And then starting in chapter 3, we start focusing on balance sheet accounting. We start dealing with accounting for investments in chapter 4 with our discussion consolidations. Then we just start marching down the financial statements. We deal with long-term items in chapter 3. We deal with liabilities in chapter 5 and so on. Okay, so we're going to go through this stuff, but most of this stuff is fairly light coverage on the exam. So if you take a look at this all the way down to the SEC reporting, these are all 2-point areas. Okay, very, very light areas that we're going to get into. Now they talk about special purpose framework, and that's also fairly light. Okay, but what they kind of have hidden here is the big point value, which is converting cash statements, cash financial statements to accrual, and the other way around, and vice versa. Vice versa means the other way around, and vice versa, churning, accrual statements into cash, and that's 10 points. Okay, you will get a chunk of questions there, so they don't even call it out on the outline. Meanwhile, it's probably a 10-point area. Ratio analysis is about 5 points. I'm going to show you before we conclude tonight what I want you to do with those ratio analysis questions, because I'm not going to spend a whole bunch of time here saying current ratio, divide current assets by current liabilities. I don't have a whole lot of value to add to that, but you do have to know those ratio. You will probably have a task-based simulation, and I'm going to ask you to flashcard those. You probably already have them in your Becker flashcards. And then partnerships are about 5 points. Okay, so those are the sense of the point value, but you can kind of see I can't call out a pattern here. We're looking at income, we're looking at balance sheet. It's all over the place, right, in terms of the different things we're looking at in this chapter. And they're all pretty much lighter areas. Okay, now you come over and you start to look at the notes to the financial statements. And what we're really talking about here is the footnote summary of significant accounting policies. And I think that you have probably been required in one of your classes to take a look at that footnote. It is usually the first or second footnote in the financial statements, and it explains things like what? Like the measurement basis, okay, accounting principles, what are the depreciation methods, inventory pricing. Are we using completed contract or percentage of completion method to account for our contracts? That sort of thing is in that first footnote. And I have this class at Stanford that I teach that I'm teaching to non-accountants. And one of the items I have them do when they do financial statement analysis that I have them do is look at that footnote and understand what's going on with the company's accounting. Okay, and I have to answer some specific questions about that. Okay, so all of those things would be in that summary of significant accounting policy. Now, as we know, there are a bunch of other footnotes that are in the financial statements. Okay, for example, fair value estimates, estimate of loss contingencies, these sort of things. The point here, these are good examples of footnote disclosure, but they are not the summary of significant accounting policy. So what the examiners will do, they'll say, what will be included in the summary of significant accounting policy footnote disclosure? They'll give you items that are appropriate footnote disclosure, but they're not in that summary of significant accounting policy. Okay, so that's the main thing you need to remember there. Okay. Okay, good. Now you come over and we talk about disclosure of risks and uncertainties. Okay, and again, this is an area that I ask my students to focus on. I have them choose a company, and then they have to do an analysis of their 10K report. And one of the things I ask them to look at are their discussions of risks and uncertainties. And when you look at the 10K report, beyond just the financial statement footnote disclosures, the 10K report, I think it's section 1A or 1B of the 10K, also requires a company to call out certain risks, et cetera, right? So when we talk about risks and uncertainties, let's just go ahead and let's look at the notion of uncertainties. Okay, and the uncertainties are for estimates. So when we talk about uncertainty, we're talking about the uncertainty of estimates. And the footnotes will have the statement that says, hey, we have a lot of estimates in here and the results could differ. You got to put that in there because when you're using estimates, there's uncertainty associated with that, right? Okay. Now, when you come down and we talk about risks, what kind of risks are we talking about? And what they're really focusing on here when they talk about risks are risk associated with concentrations. Okay, so when they talk about risks, where are we? Current vulnerability due to certain concentrations, that's the risk, guys. That's the risk that they're talking about when they talk about risk and uncertainties. And the disclosure requirements relate to concentrations, okay? And concentrations should be disclosed if they meet the criteria here, which I want you to flashcard. The concentration exists. It makes the entity vulnerable to near-term impact, okay? It is at least reasonably possible that the events that could cause the severe impact will occur in the near term. So I don't know if you were an entity, let's say, and you had some subsidiaries who were involved in Russia. Yeah, I think you got a concentration risk there that you're going to have to talk about, right? And these are the kinds of things that they would expect you to be calling out. Okay. Okay, good. So we got risks, which is basically estimation risk. Why don't you go ahead and flashcard that's an estimation risk. Okay, and we've got uncertainties. What do we mean by uncertainties? We're talking about concentrations, and if you have these certain concentrations, you're going to have to footnote those. I almost said flashcard them. You should flashcard them, but you're also going to have to footnote them in the financial statements. Okay. All right, good. Let's go ahead then. And let's take a look at question 1 here for our second chapter tonight. Okay, guys, let's go ahead and take a look at this one. And okay, a good chunk of us got this one right, 75% anyway. There were a few folks that chose B, and I think maybe if I can diagnose that a little bit, what may have happened there is when you were looking at the discussion of risk and uncertainties, you were thinking that we meant that to be included in the summary of significant accounting policies. And so some folks maybe thought B was the answer. It was not, because maybe there's some sort of risk associated with guaranteeing the indebtedness of others. You would disclose that. It is not a summary of significant accounting policy, and risk and uncertainties is not part of the summary of significant accounting policies. It's something that has to be disclosed, though. We were just mentioning it there. Okay. So, but how you determine what a cash equivalent is things that have an original maturity of 90 days or less. For example, treasury bills are considered cash equivalents, and we'll talk about that more in chapter 3. But that would be the kind of thing that you would disclose in the summary of significant accounting policies. Okay. Okay. I don't think anyone got sucked in on any of these others. These are, the other wrong answers. These are good disclosure items, but they're not summary of significant accounting policy. Okay. Okay, good. Let's come over and let's take a look at the discussion here in module 2 of subsequent events. Okay, now what happens? We are going to issue our financial statements. Year end comes, and there's usually a 30, 60, 90-day period for companies before they issue the financial statements. Well, unfortunately, the world refuses to stop from the end of the year to the day we issue our financial statements. There's a whole world going on out there, right, that can happen. And there are requirements that we may have to either book something in the financial statements, literally make a journal entry, debit, credit, or we may have to disclose something that has happened from the date of the balance sheet to the day we actually issue the financial statements. Okay, so they tell us here that a subsequent event, just giving us the definition, a subsequent event is the event or transaction that occurs after the balance sheet date, but before the financial statements are issued. And they can fall into 2 categories. Okay, we can have a recognized subsequent event. Recognized subsequent event means that we will make a journal entry. We will recognize it. We will make a journal entry to affect the financial statements. And then there are non-recognized subsequent events, and you can put no journal entry, but what? But disclose. Okay. And you can do a flashcard over here. What are the 2 types of subsequent events? Okay, and the 2 types are what? One that is recognized and one that is considered what? Non-recognized. For the recognized subsequent event, make a journal entry and disclose. I should have put that there. Make a journal entry and disclose. And for the non-recognized subsequent, no journal entry, but you are to disclose. Okay. Now, let's just take a look at what they tell us here in the text. Recognized subsequent events provide additional information about it, conditions that existed at the balance sheet date. Entities must recognize the effects of all recognized subsequent events in the financial statements. In other words, what? Make a journal entry. Okay. Now they give us some examples here. Okay. Settlement of litigation. If litigation that arose before the balance sheet date is settled after the balance sheet date, but before the financial statements are issued, the settlement amount should be considered when determining the liability to report on the balance sheet. In other words, you will debit a loss for whatever the amount was, and you will credit what? The contingent liability now, because there's been a settlement. Okay, you know, you have to pay $50,000 next year. So you debit the loss, you credit the liability, because what? The lawsuit had arisen before the balance sheet date or on the balance sheet date, and then it was settled before you issued the financial statement. So you've got good information about the outcome of that lawsuit, don't you? So they actually require you to recognize that. Okay. Now, the more tricky one here is the loss on uncollectible receivable. The effects of a customer bankruptcy filing after the balance sheet date, but before the financial statements are issued or available to be issued, should be considered when determining the amount of the uncollectible receivable no longer recognized on the balance sheet. Now that's confusing, because you say, but wait a minute, they filed bankruptcy after the balance sheet date is what they say here. Yeah, but the issue is that the conditions that led to the bankruptcy are assumed to have been in motion, in effect, what? Before the balance sheet date. No one goes bankrupt overnight, right? So they were already heading towards bankruptcy. The fact that they didn't declare it until after is neither here nor there. And that's a tricky one. You will see questions that will try to pull you into that. So declaration of a bankruptcy after the balance sheet date is a recognized subsequent event. Now, just to kind of, you know, think through how that would work, think about it. If they go bankrupt, what are you going to do? And you have to write off that receivable. You'll debit the allowance. You'll credit the account receivable, won't you? To write it off. And then what's likely to happen when you debit the allowance, the amount of the allowance is going to go down. Well, before this happened, you were maybe satisfied with the amount of the allowance. Now, when you debit it, it's gone down. So you're probably also going to do what? Have to come up with a new estimate as to what needs to be in the allowance now after it's come down, and what? Take a bad debt expense to increase the amount of the allowance. So that one would have a, whoops, what the hell's going on here? That would have had what? A potential chain reaction of journal entries, right? Okay. Now, if we're talking about a non-recognized subsequent event here, the entity should not recognize subsequent events that provide information about conditions that did not exist at the balance sheet date. Okay. However, as I had you put on the flashcard, what? Non-recognized subsequent events should be disclosed. And by the way, recognized subsequent events should have a footnote disclosure as well, right? So it's either what? Recognize and disclose, or what? Don't recognize, but always what? Always disclose. Anything that's asking about a subsequent event, disclosure is going to be part of that right answer, isn't it? Okay. Okay, good. Now you come over and they give us some examples here of subsequent events that occur after the balance sheet date, but would probably be disclosed. For example, loss of plant or inventory because of a fire, natural disaster. Everything was fine at December 31st, and then a hurricane came and wiped out our facilities. Okay, and that happens what? Before we issue the financial statements, you'll still show in property, plant, equipment, whatever the amortized depreciated cost was of that asset, but actually there's a hole in the ground where that used to be, right? So what do? You got to create a footnote disclosure about that. You got to disclose that. Okay. Now, I don't know, I find this a little bit annoying, but let's just go ahead and flashcard it. Okay. An entity that files financial statements with the Securities Exchange Commission must evaluate subsequent events through the date the financial statements are issued. All other entities must evaluate subsequent events through the date the financial statements are available to be issued. And then they tell us that financial statements are available to be issued when they're in the format that complies with GAAP and all proper approvals have been obtained. Okay, I don't know what to tell you, this flashcard, I get annoyed This is why I'm sorry I became an accountant when I see stuff like this, but let's go ahead and flashcard that. It's just a rule. Okay. Okay, good. If you reissue financial statements, okay, the entity should not recognize events that occurred between the date of the original financial statements when they were issued or available to be issued and the date the financial statements were reissued. You know, that gets very cumbersome if you had to reissue. Now you got to say, well, gee, do I have to disclose subsequent events because now all this stuff maybe has happened since I originally issued them and now I'm reissuing them? They get you off the hook with that rule there, and you can flashcard that. Okay. Okay, good. We don't need to go through a list of examples of subsequent events, whether they be recognized or de-recognized. Let's just go ahead and practice our understanding with this question here. Okay, guys, we're coming up on the 2-minute mark. I'm going to go ahead and end the poll here. You know, question like this, CPA exam day, we're talking what, 15 seconds, 20 seconds, however long it takes you to read the question, right? And then you should be able to quickly identify the answer. So let's look at it though. Most of us got it right. Okay, 75%. I would have thought we'd be more like in the high 90s here, or even 100%. Ace company settled litigation on February 1st, year 2 for an event that occurred during year 1. So the thing existed at the balance sheet date and was settled what in the next year, right? Okay. An estimated liability was determined as of December 31st, year 1. This estimate was significantly less than the final settlement. And that can happen. Hey, I thought it was going to be this. Looks like it's going to be that, right? The transaction is considered to be material. The financial statements for year and year 1 have not been issued. What should we do? Use the actual outcome and book that, right? It existed at the balance sheet date and we have better information. And of course, we always what? We always disclose, right? Okay, so when I look, I see somebody chose choice C, and I'd like to know why. Because we said that what? There's always disclosure. Okay, for all of the subsequent events, there's always disclosure. So if you chose C, I think maybe you're just trying to choose anything to make it seem like you're following along. Don't do that. Okay. Okay, good. Let's go ahead and let's take a look at our next module. Any question on that one? Okay, good. Let's look at our next module here now, which is fair value measurements. So what happens? FASB looks at some items and they tell us, hey, we can use fair value to account for these items because, say, in the case of a publicly traded stock, everybody agrees as to the value of that stock on that date, don't they? Okay, so we'll use fair value measurement for that. Other items that might be a little more subjective, for example, property, plant, and equipment, we're going to use what? We're going to use historical cost, right? And remember we talked about the different measurement attributes at the very beginning when we were talking about the conceptual framework in our first module, chapter 1. So when we look at fair value, okay, they tell us that fair value, there's going to be an objective way to measure that. And it is the price that would be received to sell an asset or transfer liability in an orderly transaction. Okay, some key words, key phrases here. Orderly transaction. That is saying that I have time to properly market it, consider different offers, and pick the what? Pick the best offer. The best example I could give that may be more recent was when we had, the housing crisis, the housing market crisis back in 2008, and people were just walking away from their homes, right? Because they were saying, hey, I'm underwater and I don't want to do this anymore. Well, that's not an orderly transaction. That's walking away, right? Whereas if you have time to continue to hold that asset, market it properly, et cetera, the way we might be in a current housing market, that would be more of an orderly transaction. Okay. Now, when you consider this, you have to look to the most advantageous market or to the market in which you have is your principal market. So either the principal or the most advantageous market that you'll use. So you will use the principal market. If there is no principal market, then they allow us to use the most advantageous. Flashcard that. Don't worry if you're right now. We're gonna look at some nice examples they have here, and we'll be in good shape. Okay, but orderly transaction, and we look to what? The principal or most advantageous market. Okay, flashcard that. Now we come over, and when we talk about a orderly transaction, okay, and they tell us orderly transaction long enough to allow for marketing activities that are usual and customary. Okay, when we talk about principal market, right? So you see, guys, how we're coming down and kind of defining some of those key phrases. Okay, when we talk about principal market, the principal market is the market with the greatest volume or level of activity for this asset or liability. And if there is a principal market, the price in that market will be the fair value measurement. Okay. Come down to most advantageous. The most advantageous market is the market with the best price for the asset, okay, or liability, after considering transaction costs. Okay. Note that although transaction costs are used to determine the most advantageous market, transaction costs are not included in the final fair value measurement. Okay, and they tell us that we use the most advantageous market only if there is no principal market. Okay, so what happens? First, you look to the principal market. If there is no principal market, you use the most advantageous. You use the most advantageous after you consider transaction costs, but when you report the fair value, you don't include the transaction cost in the reporting of the fair value. Now you look at that and you're like, what? Let's look at this example. Very nice little example, and I think you'll see it's a piece of cake. Okay, so we've got what? We've got this, and I'm just gonna go ahead and make sure you realize this example is making this point here. Okay, and so you come down and they give us some information, the quoted price for New York, for London, transaction cost. What is the net of the transaction cost? 52 minus 6 equals 46. 50 minus 2 equals 48. I think you see how they're getting the net there, right? Okay, now you look and they say, well, what should we do here? And notice they tell us that if New York is the principal market, then use the New York price. If London is the principal market, then use what? The London price, right? If there is no principal market, then you have to use the most advantageous after considering transaction costs. So when you look at this one now, so I guess maybe I need some green here, okay? When you look at this one now, okay, notice that what? 48 is the most advantageous after we consider the transaction cost, but when we report it what? We report it the 50. We don't report it at 48. Question? Most advantageous when there is no principal market. Most advantageous when there's no principal. To figure out what the most advantageous is, you consider the transaction cost. When you report it, you don't net out the transaction cost. Okay? Okay, good. Now, if you have a non-financial asset means that we're not talking about stocks and those sorts of things, right? Non-financial asset, and you're trying to figure out the fair value of that. The fair value measure of non-financial asset takes into account the market participants' ability to generate economic benefit by using the asset, and you look to the highest and best use, or by selling it to another market participant. Okay, so you're looking to the highest and best use, or what would I get if I were to sell the asset to determine its fair value. Okay, a reporting entity's current use of a non-financial asset is presumed to be the highest and best use for them to be able to maximize the value of the asset. Liabilities and financial assets, the highest and best use concept is not relevant, okay, because there is really no use for liabilities, and there is no other use for a financial asset. It's whatever its value is. So for non-financial assets, we use highest and best use. For non-financial assets, we use highest and best use. For financial assets, it's not relevant. What are you doing to me here, thing? What is this? I don't want to play Twinkle Twinkle Little Star. What's the problem here? Okay, let me exit full screen. And come back to full screen. Save that. Makes this nonsense go away. Okay, let me close PDF. Okay, so it looks like it closed it now. I'm going to discard. Okay, and full screen. We're on page 17. This way. What page are we on?
13.
13. Okay, and the scary part is always when I put it in tablet mode. So it likes to lose the camera at that point. If I do, I'll continue without the camera. We're still good. Okay. And I asked you to highlight this, and then I was trying to get to the flashcard. Simple. Okay, now you come over and let's take a look at the fair value measurement framework. Okay, so what FASB did some years back is they gave us a hierarchy for determining fair value. Okay, so let's just take a look at the different approaches, okay, that we can use. And they give us 3 different approaches. We can use the market approach, the income approach, or the cost approach, and we can use a combination of those. So the market approach uses prices and other relevant information from market transactions involving identical or comparable assets and liabilities to measure fair value. And you can flashcard that, but just to give you a sense, these same approaches, and I think FASB borrowed from appraisal standards here a little bit, and that if you're talking about how you appraise property, I was on an assignment with the GAO some years back where they were asking us to look at different methods for appraising commercial real estate. And the reason Congress was interested in that is they were worried that there was going to be a crisis in the commercial real estate market. And they wanted to see what the appraisals were for those, if they were appropriate, because the loans that are backed by the federal government are largely based on those appraisals. So the federal government was interested in appraisals. And when we looked at that, we learned that you could use a market approach, okay, as one of the ways of doing that. So what's the market approach? Well, if you ever had your home appraised or commercial real estate appraised, what do? They look at other real estate that looks like yours, and then they say, okay, this is the value of yours. Now, the problem that I have with those appraisals is they are, in my opinion, highly subjective, because what they do is they'll, I had a newer house in, it was a brand new house. And they did the appraisals. The only other houses around my house that was in an older neighborhood were like, 60 years old. And they're comparing a 2-year-old house to a 60-year-old house and saying, those sold for that, so yours will sell for that. I'm like, no, for that price, someone can stand at the curb and look at my house. I'm not going to let them buy it for that amount. So sometimes, these appraisals get a little subjective, but that's sort of what happens. They look at similar properties, similar assets, liabilities under the market approach. Okay. Under the income approach, what they do is they figure out, well, what would be the income that can be generated by this asset? And then they go ahead and they do what? They discount those amounts to come up with a fair value for whatever that asset is. This would probably be more used if you're trying to acquire a business. You'd want to see what kind of income the person generated off of that business, and then you would come up with that and discount those amounts and say, okay, here's a fair value. I'll make an offer of this amount for your business, whatever. The cost approach says, well, what would it cost me to replace that asset? And so you might go and look at the current selling price of similar assets that they might want to replace. Okay. Now, where we're going to come in is, as we use these methods, we will have inputs, okay? And there's a hierarchy of inputs, which level 1 is the best, and level 3 is the lowest priority. So the idea is that you should first look to see if you have level 1 inputs to determine fair value. Level 1 inputs are quoted prices in active markets for identical assets. Okay, for example, quoted prices on the New York Stock Exchange. Piece of cake. You hold 20 shares of Apple stock. Apple stock is trading for X per share. Multiply the number of shares you have times that year-end quoted market price. You're done because you have those level 1 inputs, right? Okay. Now, level 2 inputs are a little more difficult because you may not have quoted prices for that exact item, but you could look at quoted prices for similar assets. So maybe it's a stock that's not listed, so you can't look to the stock exchanges for that for the fair value of that, but they have a stock of a company that is very similar to Apple, let's say. And so you could sit there and maybe use the level 2 inputs for similar assets. Okay. Now, again, this is a hierarchy. First, you look to level 1, piece of cake. Then I got to look to level 2. In the absence of level 1 and level 2 inputs, you got to look to level 3. And they call that unobservable inputs. And it reflects the reporting entity's assumptions and should be based on the best available information. And you're looking at that and you're thinking, well, that sounds a little squishy. And you're right, your accounting instincts are right. And so they tell us, hey, only use level 3 if you can't find a good level 1, level 2. Okay. So flashcard, what we mean by these different levels, and just remember that you start, hopefully you got level 1 and then your last resort, then you go to level 2 and your last resort is level 3. Okay. Now, when you come down to fair value disclosures, okay, let's go ahead and flashcard these. Okay. And I think you see, guys, when it comes to disclosures, I tend to just ask you to flashcard these disclosures, these sort of mundane rules, if you will, for lack of a better word. You're best off just flashcarding them, right? In case you get a simple question, what has to be disclosed, you got a flashcard of it. Remember, you're going to be looking at your flashcards the day of your exam before you go in. And so you'll be able to answer questions like this. So what needs to be disclosed when we're looking at fair value disclosure, and I want the flashcard there, I want it down here. Okay, so specifically, an entity must provide the following disclosures about fair value measurement. Let's just flashcard these: the quantitative information that was used for the unobservable inputs, discussions of the sensitivity of those level 3 measurements, information about non-financial assets that differ from the highest and best use, and the hierarchy of items that are not measured on the balance sheet, but are disclosed in the notes to the financial statements. Okay. I don't know. Let's look at this example. I mean, guys, it seems like much ado about nothing here when you finally come to the answer, but they have these 3,000 shares of this common stock, and the time of the purchase, they were $24 per share. At the end of the year, they've dropped down to $21.50. So what are we going to report it at? Well, we have the 3,000 shares at $24, total 72. Now those have dropped down to $21.50 per share times the 3,000 shares is 64,500. We have what? A $7,500 loss. So we will go ahead and do what? Credit the investment account, debit, and this would be what? This would be, and they say the other side of the transaction will affect net income. I guess they're assuming here that this is what? This is a trading security, and trading security affects net income. If it's available for sale, it would affect what? Other comprehensive income, right? Okay. Okay, and we'll get more into this in chapter 4. So, all right, good. Let's go ahead and let's take a look at this question. Okay, guys, let's go ahead and take a look at this one. I'm really starting to think through how I should handle, because I find it hard to believe that only 71% of the future CPAs coming from Golden Gate University got this question correct. Okay, I think that we laid out the rules and we had an example that was just like this. So I'm starting to wonder if I'm going to have to call on each individual to get their answer going forward. Maybe that's what I'm going to have to start doing, so I can kind of start to tease out who's not paying attention. Because we said very clearly that you do not consider the transaction prices, the transaction costs in reporting the fair value. So if that's the case, there is no way that A or B can be the answer, because you don't net out the transaction cost. I mean, that was a very straightforward rule we said, right? Then we said what? Then we said that you use the principal market, but there was no principal market. So then you turn to what? Most advantageous after considering the transaction cost. And so what happened? When we looked at that, then we saw that New York had the what? Had the most advantageous, but again, you do not net out the transaction cost when you report that. So you pick New York and you would report it at 103. So I'm not sure why we're getting a 71% correct rate on a question that's that straightforward. Anyone have any thoughts? Okay, I'm going to start calling out individuals. Okay, all right, good, because I need you to be engaged. All right, let's look at segment reporting here. Okay, now what happens with segment reporting? When we have a company that has different subsidiaries and whatnot, what do? We take those subsidiaries and we consolidate them into a common company under common control, right? So we're going to take company A, company B, company C, consolidate them, and that's the way we report that information externally. Is that how the management, the CEO of the company, the chief operating officer, whatever, is that how they run the company? No, they're looking at what? They're looking at their European division, their US division, this product line, that product line, right? So what happens? There's a bunch of information that the chief decision makers have in their hands that are not part of what went into making the financial statements. Okay, so FASB looked at that some years back and said, well, if you've got that information, you should disclose it. You should put some of that information in your footnotes. Now, the companies looked at that and said, do I have to show everything? I mean, that's going to get a little cumbersome. That's going to get a little tedious. And FASB says, no, just the big stuff. Okay, so let's think about what that means, the two takeaways here. The two takeaways are the information that's going to be provided is information the company already has available. It's not new information they're going to have to create. It's information they already have available. And it's not every single thing. It's what? It's the big stuff. And we are literally going to see that there are quantitative thresholds that we will apply to determine what that big stuff is. Okay? All right, good. So let's just go ahead and let's take a look at this. And of course, this is a little silly because everything FASB does is supposed to help users, okay, financial statements. So let's see what the required disclosures are for public companies. Okay, so this is the scope for public companies. And when we say disclosure, that is another way of saying what's going to be in the footnotes for our segment information. Okay, and the business entities must show information about operating segments, geographic areas, etc. Okay, Now, the accounting that is used is the same accounting as the main financial statement. So if they're using last in, first out inventory method for the main financial statements, the disclosures about segments will also use last in, first out. Okay. Intercompany transactions are not going to be eliminated. Okay. When we consolidate and there's a sale between segment A and segment B, we eliminate that, don't we? For our segment information, they want each segment to look like a standalone business. So there are no eliminations for for segment reporting for intercompany transactions. Okay. And as we've already shown you above there, the scope is public companies only. And I guess you can go ahead and flashcard that. Okay. Now you come down and so it does not apply to not-for-profit entities in non-public companies. Okay. Then you come down and the definition of a segment depends on how management uses the information. Okay. So you can flashcard that. There is no rule as to what defines a segment. It's how does management look? What is the information you have on your desk? That's what we want you to provide. Now, we're not going to have to provide everything, okay? But we're going to see that some things FASB determined are significant enough to have to report. Now, not every segment is an operating segment. So corporate headquarters is not a segment. Pension plans are not considered an operating segment, although there are specific disclosures around pension plans. It's not something that is considered a operating segment that would be relevant to this discussion. Okay, so we've got certain things that they're coming right out and telling us they are not operating segments, and then they're going to give us quantitative thresholds for determining which segments are big enough that they have to be included in those disclosures that we're talking about here. Okay, so we have 3 tests. All of them are 10% size tests. We have the revenue test, we have the reported profit or loss test, we have the asset test. And a segment only needs to meet one of these tests to be considered a reportable segment. So if you don't make it on the revenue test, you may have to disclose that segment based on the reported profit or loss or asset test. Okay, now let's take a look at the revenue test. Okay, and I want you to flashcard these guys. Flashcard at a high level what the 10% tests are, because the question may say, applying the revenue test, do we have a reportable segment? But they're not going to tell you that's a 10% test. So you need to know that these are the 10% test. Okay, and basically with the revenue test, what we do is we will take all of the revenue of the segments. And again, guys, we do not eliminate intercompany sales for this test. So we take all the revenues for all the segments, add that number together, multiply that number by 10%, and any segment that has a revenue greater than or equal to that 10% number is a reportable segment. If a segment doesn't make it based on revenue, then we'll do the same thing for assets. Let's come down to the asset test. We'll take all the assets of all the segments, add them together, multiply that number by 10%, that big added together number by 10%, and any segment that has assets greater than or equal to that 10% number is a reportable segment, even if it didn't meet the revenue test. They only have to meet one of these, okay? And then the reported profit or loss test, what we do is we take all of our loss segments and we add them together. Then we take all of our profitable segments and we add them together, okay? And then by doing that, what produces the larger absolute value amount, that will determine whether or not we have the reportable segment. And then any entity reporting a profit or loss that is greater than that absolute value number would be a reportable segment. Okay, so for that one, I'm going to ask you to see MCQ, okay, 05 0.055. Okay, and let's just look at that together. Okay, because that one reported profit or loss thing gets a little hard to visualize. And so come on. So I'm going to go ahead and show you that one. So let me exit full screen. Open my browser. Becker. One time I was at a baseball game and I had some seats that were kind of close to the front, you know, and as I walked down the aisle, all of a sudden I heard someone yell, "John Lord." And the guy looked up and the guy was standing up there and he goes, "Becker." So I assume he must have passed the exam. So Becker. Okay. All right. So let's just go ahead and let's take a look at this question. And I want to find, what is this? Oh, you can search on the task-based simulations now too. Okay, that's cool. Okay, and let's look at 05055. Okay, okay, good. And then I'm just going to go to the solution. I think it's this one. Okay. All right, good. Now, when we look, notice what they did here, guys. They give us the different components. They give us the eliminations. They give us the consolidated. This net elimination consolidated is useless. We're only going to look here. And what we're going to do is we're going to group what? We're going to group the profitable segments with the what? With the loss together, and then we're going to group the loss segments together. So when you look, what they did here was they took, where's the solution? Where did they do this? What did they do to me here? Okay, here they go. So the income, the loss. So right here in the solution, right? So they're picking the income or the loss, and they're taking the what? 215, the 30, and the 80 are all the profitable, and then they pick out the two losers, Carter and Elbow, and they pick those up. And when they add up the profitable, they add up the losers, the profit has a higher absolute value, doesn't it? So they take that 325,000, they multiply it by 10%, and then any segment that has a profit or loss greater than that 10% number will be a reportable segment. So now I go back through, and I'm not 325,000, but 32,500. So now I go back through and I start to look at what? I look at Astor. Yeah, Astor is greater than the 32.5, so it's going to be a reportable segment. BJAX, no, on an absolute value basis, it's not big enough, right? Because it need to be 32.5 or more. Carter, yes. Davis, yes. Elbow, no, because it was only 20,000. Okay, so that's why it's Astor, Carter, and Davis. Question? Serena? Can't hear you. Unmute, please.
So I have a question. Of 325,000, we need to tie 10%. Oh, to use to compare.
32,500. Huh?
Oh, so when you tie 10%, that would be 32,500, and we use that number to compare.
Then
right?
I look for any segment on an absolute value basis that is bigger, equal to, or bigger than 32.5.
Okay, got it. Thank you.
Yep. Okay. Okay. So that's how that rule works, and it's a picture's worth 1,000 words there. I think trying to explain it from the textbook gets a little daunting, but if we look at that example, you see where that's coming from. Okay. Now you come over and we have another rule here, which is the 75% sufficiency test. Okay. And with the 75% sufficiency test, what we do is we have to see, have we reported enough segments now using the 10% test to constitute at least 75%. And now we look to the consolidated revenue. Okay, so if the total of consolidated revenue by the segments is less than 75% of the consolidated revenue, additional operating segments need to be identified as reportable segments until we have represented at least 75% of the consolidated revenue. Okay. And then they kind of say, okay, but as a practical matter, you know, so that you don't overwhelm the reader of the financial statements, you should probably not have segments that are much greater than 10 segments, because then we start to violate the understandability principle, because we just have too much information. Okay, so for the 75% sufficiency rule, flashcard that, but let's look at multiple choice question 00127 for that. And that's a fancy way of saying, let's go ahead and let's look at our class question for this. Okay, as they go on and on here, which is stuff that's just sort of beyond what we need to worry about right now. So let's do this one, but let's do it together. Okay, so we have this this segment. I'm not going to put up the poll, guys. We're just going to do this one together. We have this information, and they want to see which one of these are reportable segments, and they tell me to use the revenue test. That's why I did flashcard, because what? They don't tell me the revenue test is a 10% test. Okay, now I look and I say, okay, I have what? I have unaffiliated, I have intersegment sales, I have total. Okay, now what do? I look to the unconsolidated number, don't I? I don't worry about elimination. So I pick up what? I pick up the 83,000. I take that 83,000 and I multiply that by what? 10%, which I had to have memorized that it's a 10% test or I couldn't answer this question, right? That gives me 8,300. Now I go through and I look to the segments to see which have revenues reported unconsolidated greater than or equal to that 8,300 number. So how about Allo? Speak to me, guys. Allo is what? Allo is no. How about Bix?
Yes.
Yeah.
Yep, Bix is big enough. How about C?
No.
No. How about Dill?
Yes.
Yes.
Yeah, Dill. Okay, good. So right now, I'm thinking the answer is Bix and Dill, but I got to make sure I have enough segments under the 75% sufficiency. And the 75% sufficiency said that I should do what? That I should take the consolidated revenue and see if the segments that I've identified using the 10% test are giving me at least 75% of the consolidated revenue being reported. So I've picked so far what? I've picked Bix and Dill.
Yes.
Okay, so now I go to what? Now I go to the consolidated number, 8,000 for Bix, right? 43,000 for Dill. 43,000 plus 8,000, they're basically consolidated revenue is 51,000. Divided by what? The consolidated revenue of 60,000. And that comes up to what? 85%? Think on the dot, it's 85%. Okay, so they have what? I've represented 75% of the consolidated revenue by picking these two segments, haven't I? And I believe that that will be the case for most questions, because what happens? If you were less than 75%, there's no rule as to how you get over 75%. You can start adding segments however you want to get you over the 75%, and that becomes a tougher question for them to ask. The only thing I can think of that they would have to do here is maybe you'd have to include one particular segment, and that's the only way you get over the 75%. That's how I could see them potentially testing that. But my prediction is most of the time you'll be at the 75%. Question? Okay, good. Let's take a look at SEC reporting. Now, guys, when we get into what they ask us about the SEC reporting, it gets annoying. Okay, it gets annoying because they want us to tell them things like how long do we have to file these different SEC reports and stuff. And I get annoyed by that because I'm like, if I need to know that as a CPA, I will look it up. Why do I have to walk into the CPA exam with that shit in my head? Okay, but unfortunately, they write the exam and I can't control them. Okay, so what we're going to do is we're just going to flashcard this stuff as to what the requirements are. I don't have much more to add to it than that. And I'm going to give you specific questions from your homework that address these issues. So all you're going to do for this stuff is make the flashcards and then go to those multiple choice questions. Okay, that's how you're going to practice for this. Okay, all right. So if you're a public company, you have to file an annual report with the SEC. As you probably know, we call that report a 10K. And the bigger the company is, the less time they give them to file that. Okay, and so you can flashcard those time frames, and then you can see multiple choice question, and I'm just going to rattle them off here to you guys. 0, 9, 0, 7, 0, 6, 6, 1, 8, and 0, 7, 2, 1, 5. Okay, now when you go to these questions, okay, if you see something that you believe is flashcardable from those questions, go ahead, make another flashcard on that. Okay, I had you flashcard what I think is key here, but you know, if you want to add some flashcards, you can do that. Okay, also the 10K financial statements are audited. I don't know if they say that anywhere in that discussion. Okay, but the financial statements are audited, and that point is tested or whatever shown to you in a question in 05470. That's a multiple choice question. Okay. Okay, good. Now, you can also see they start getting into what is a large accelerated filer or whatever, okay, which is also very annoying, okay, that they ask that. Okay, so they start to give you some of that information as to what constitutes a large accelerated filer, et cetera, okay, and the amount of time that they have to file these things. And so you can go ahead and flashcard that in this pass key, as though that's going to make you pass the exam, which is ridiculous. But 08736. Okay, and I'm sorry if I have a little bit of a bad attitude about this stuff, but why wouldn't somebody just look this up? Okay, but multiple choice questions will help you practice with that. Okay, now a Form 10Q is the quarterly statement that must be filed by public companies with the SEC, and again, they give us the time frames for that. Okay, and flashcard that 45 days, whatever, and that is tested in question 08721. I'm not going to write MCQ. I guess I'm not going to do it, and then I do it. Multiple choice question MCQ 08721, and this information is unaudited. Okay, and you can flashcard that. Okay, okay, good. Come over, and we've got forms 20F and forms 20F and 40F. F equals what? Equals form. And there are some foreign entities that are allowed to list on the US stock exchanges. And depending on whether you are the Canadians or everybody else, okay, you will use 40F or 20F. And these statements are audited, okay? And you can go ahead and flashcard this 20F, 40F. And then the way I kind of think of this is my new friends are only 20, but my old friends are 40. My old friends are the Canadians, and my new friends are everybody else. I don't know. Okay, but just go ahead and flashcard that. And those statements are audited. Okay. Now you come over and they start to talk about Form 6K, and these are the semi-annual forms that are come from the foreign companies, and these, like the quarterly statements, are unaudited. Okay, so you can go ahead and flashcard that, and then you will see that notion that they are unaudited examined in questions 06078 and 08590. Okay, and then we have these 8K forms. Okay, and this one now starts to get sort of outside of financial information. So even though it does talk about things like asset acquisitions, disposals, changes in securities and trading market changes to financial statements, etc. So they're still kind of dealing with financial statements, but it's more what things like changes in the corporate governance. Okay, so flashcard, it is a form that reports major corporate events such as, and then you can see the examples there. Okay, and you'll see that in F, multiple choice question. These are all multiple choice questions number, even if I didn't put in MCQ. And it's multiple choice question 08999. Okay, for that one. And then these forms, an easy way to remember what goes into these forms is there's really no financial information in these. All they're talking about here is the names of the officers, that sort of thing, but there's really no numbers on these. Okay, so if you see something that's being called out and they don't really talk about a lot of financial information, but things that are, you know, owners and who are the directors and that sort of thing, not owners, but the directors and whatnot, then that is going to be these forms with no letters on them. Okay, and so that's what 06077 and 06807. Okay, now we also have this regulation SX. Okay, and what regulation SX does is it sets forth the content and requirements for interim and annual financial statements that are to be filed with the SEC. So just know what that regulation SX does, and that is tested in question 03975. Okay, and then we start getting into what needs to be presented under that regulation SX. And so they start talking about the interim statements here. Okay, and I just want you to flashcard what needs to be provided in the balance sheet. And it's basically talking what quarters need to be provided. Income statement, what quarters need to be provided. Okay, and you can go ahead and flashcard that. The balance sheet question gets asked in 06080. And And then you can come over and for the statement of cash flows, same thing, what needs to be provided for the statement of cash flows. Okay, guys, and I'm not reading through that because it starts to become the period before and the period after. I have nothing to add other than what they have said here, okay, as to what needs to be provided. Okay. Okay. One thing I want you to flashcard, and I find it interesting that they give you all of this, and then they don't tell you anything that will help you answer, probably to me, the more interesting question, which is 00237, multiple choice question, okay? And the flashcard that I want you to put right here, okay, is for interim statements. Okay, we're talking about basically quarterly statements. Okay, for interim statements, take revenue in the period it is earned, allocate expenses to the periods benefited. Okay, so if they earn a revenue in the first quarter, take the entire revenue in the first quarter. But if they spend, you know, $100,000 and it's going to benefit all 4 quarters, then you would take 25,000 in the first quarter, 25,000 in the second quarter, 25,000 in the third quarter, 25,000 in the fourth quarter, right? Okay, so for revenue, take the revenue in the period it is earned. For expenses, allocate those over the periods that will be benefited. If it's going to benefit all 4 quarters, take the total amount of the expense, divide it by 4. Okay. Okay. Now for the annual financial statements, okay, they need to be audited. I think we already flashcarded that. Okay. And the audited financial statements must include a balance sheet for the 2 most recent years, and statement of income and changes in stockholders' equity and cash flows for the 3 fiscal years preceding the date of the most recently audited financial statements. Okay, flashcard that. That's again just one of those rules that you need to be comfortable with. Okay, now coming down, they also talk about XBRL reporting, and this is basically data tags used to describe financial information. Okay, so you can go ahead and put in multiple choice question, and for this one it's 06808, and the good way to remember this, okay, is this XBRL reporting relates to financial statement line items and footnotes. Okay, so let's say you wanted to compare the I don't know, current assets of various SEC companies, of various public companies. Okay, what you could do with that XBRL reporting is do a query that will allow you to compare all of the current assets of different companies all across the SEC filings, because they've coded this with this XBRL reporting that will allow you to do that kind of comparison. You may have done some analysis like this in one of your other classes. Okay. All right, good. So with all that, let's go ahead and let's take a look at a couple questions.
Can you please post the poll?
Oh, yeah. Yep. Okay, I'm going to go ahead and move us on from this one because it's kind of like, who cares, right? I mean, they have you ever heard of Sirius Radio, Sirius XM Radio? They have these stations that specialize in different things, right? And I always think that they should have a channel on Sirius XM, call it the Who Gives a Shit channel, okay? And on that channel, they will play this every, 15 minutes, okay? It's this information because it's at the end of the day, it's like, who cares, okay? But this is the requirement that the annual statements get audited. The interim statements, which are like the, at 6K here is a semi-annual, or if it was the 10Q, those would not be audited, right? Okay, good. Let's go ahead and let's take a look at this next one. Okay, guys, I'm going to go ahead and end this poll because it's kind of dumb question. It's just, I just find these questions irritating. I don't know what to tell you, but you do need to know this stuff. And the quarterly results, right? That's reported in the 10Q. Okay, so they tell you, well, what would be reported here, except, and if you have a place, a home for the quarterly information, the 10Q stands for quarter, then that might be another way of remembering D. And then just remembering that the 8K talks about what events that have happened. Okay, and then you have those forms without letters, the forms, what was it, 3, 4, and 5 or whatever. That's really getting away from financial information at that point in time, just giving you the names of officers and stuff like that. Okay, so when you start getting into those more obscure forms, just kind of try to keep a visualization in your head as to what those are all about, so that you can get the couple of points, 2 points that they'll maybe throw at you for these things. Okay, good. Now, the thing I'm going to do, I don't want to get into the special purpose framework stuff right now because we need more time than the 15 minutes we have left. And this is going to encompass the conversion of cash statements to accrual and the accrual to cash, which is a heavy area, and we're late in the class. And I think we are better off putting this one in our back pocket for next time, okay? And putting it at the beginning of the class when we're all still fresh and we have the appropriate time for it, okay? But I do want to come over quickly to the ratio analysis module, okay? Because I'm not going to say really anything about this other than to point out to you, okay, that they give you the balance sheet, they give you the income statement. Where's the income statement? I guess they put that in another spot. Okay, so they give you the balance sheet, and then they start showing you, I guess, a bunch of ratios that are relevant to the balance sheet. And then, where's the freaking income statement in this thing? How are you supposed to do this if they don't give you the balance sheet and the income statement? Am I missing something? Oh, there it is. The okay, they give you the balance sheet, John. I'm not used to seeing them all on one sheet like this is the problem. They give you the balance sheet. They give you what? They give you the income statement. There it is. Okay, and then they start to ask you to go ahead and do all these different ratio calculations, and I don't have a whole lot to say about, you know, how to calculate these. I mean, it's pretty much know the ratios and know how to calculate these different ratios. So I am certain in the Becker flashcards, they have all these ratios. Memorize every single ratio, okay? And be prepared to work a task-based simulation in which they'll ask you, well, what does the fact that the ratio changed from one year to the next mean? Okay, so you need to be able to do that. There's not a whole lot I can offer you on this discussion at this point in time. So your best bet is to make the ratios, memorize the ratios, work the module 7 information. There's task-based simulation and multiple choice questions that go along with that. Okay, so that means that your homework for this week is to do what? Finish up the discussion of comprehensive income and the adjusting journal entries from chapter 1, and you should be able to do the work from chapter 2 for modules 1, 2, 3, 4, 5, and 7, right? We'll come back and we'll pick up module 6 and the partnership step, whatever module that. Now I'm getting confused on the modules. Okay, so you should be able to do the modules for everything but the special purpose financial statements and the partnerships. Everything else from chapter 2 you should be able to do. We'll hit those next time, and we will get into chapter 3 next time. Okay. Serena, do you have a question? No? I thought I heard you talking. Well, you need to unmute.
Yes, I have a question.
Yeah.
On module 1 earlier, we mentioned about unrealized gain and loss. I forgot what's the purpose we're doing unrealized gain and loss. I completely forgot.
When you say module 1, do you mean the chapter 1, the module on other comprehensive income? What are you talking about? Module 1. About chapter 1? I'm confused by your call out of module 1.
I tried to say we don't pay tax after
Stop.
we sell the
What
stock.
module are you talking about?
Module. What's that? Chapter 1.
Chapter 1, module, the last module?
Yeah, the last module.
Okay, go ahead.
So why do
Second
we
line.
do unrealized gain and loss calculation? But a lot of time we don't pay the tax until we sell the stock or the property.
Okay.
What's the purpose for doing unrealized gain and loss?
Financial reporting purposes.
Financial. Okay, got it.
There's a difference between what you report to the IRS and what you report to for your financial reports.
Okay.
To the SEC, whatever, if you're a public company. So there's just different rules.
All right, thank you.
Yeah.
For me, Serena, it helped, like, what would I want to know if I was going to give a company some of my money? Would I want to know their unrealized gains and losses? Probably, even though they're not a part of the main part of the financial statement, you'd still want to know it
Okay,
if they were going to take your money, which is kind of how I look at it.
all right, thank you, Laura.
Yeah, I mean, I guess there's what would I want to know and what has the FASB told me I have to let people know. So
Yeah, but they told what we have to know based on what people want to know, right?
they receive, when they're coming out with a new standard, they receive comments that they consider from different constituents. So they consider the needs of preparers of the financial statements. They consider the needs of academicians. In other words, they can't make a standard so complex that nobody can understand it and teach it. They consider the needs of users of those financial statements. And that's their primary concern, are the users. And they get information through users through the investment community. Unfortunately, they also consider auditors, although the AICPA has pretty much told the FASB that they can audit anything that FASB requires. So they don't comment a lot on a standard. Every now and then they'll come in when something's really tough to audit. They'll say, hey, you're putting us in a difficult position to be able to audit some of the information you're requiring. But for the most part, AICPA stays silent when it comes to comments on a FASB exposure draft, but they consider all of those constituents. So yes, they do consider the needs of users and what they want to know, but they also consider other constituents as well. Okay, any other questions?
Do you have any word on the books, since tomorrow's the first? Is it the first they get released?
I didn't want to ask until it was the first. So since tomorrow's the first, I will ask that question. I'm thinking, well, I'm glad you brought that up. You should definitely, if you can redeem your book, you should redeem it. Okay, if it hasn't happened, I think Serena said last time that if you hadn't redeemed it, you could. If you haven't yet, then do that now and they'll send you the new book. Tell them that you want version, what is it? Do we know what the version that they're calling it?
4.2.
Is it 4.2? So redeem 4.2. That should be available for them to start to mail to you here pretty quick. And then for folks that maybe had already redeemed, I think I'm going to ask you to again send me an email saying that you already redeemed, and I can put out the word tomorrow. Please get these folks the book and let's see what they say to us. I didn't want to ask before the book was available. Question? Okay, guys, I will see you next week. I think you've got some work cut out for you, so have a good, productive week, and I will see you next Tuesday.
Thank you. Have a good night.
Thank
Thanks,
you.
guys.
Have a good night.
Thank you.
Bye-bye.